Disclaimer.
While the mainstream media is busy fueling panic over the recent dip, the smartest money in the room just received a green light from the vice president himself. JD Vance's move to establish a federal silver price floor isn't just a policy shift, it's a death warrant for the Wall Street shorts who thought they could suppress this market forever. Right now, as the world watches Japan, the COMEX vaults are screaming. With only 103 million ounces left to cover a mountain of paper debt, the math of this reset has reached the point of no return. Tomorrow morning, when the opening bell rings, we witness the collision of a lifetime. Today, I'm breaking down the mechanics of the Monday squeeze and why the paper-silver game is about to break wide open. Are you holding the metal, or are you holding the bag? Picture this. You're holding a winning lottery ticket, but when you try to cash it, the lottery commission tells you they only have enough money to pay 3 tickets today. There are 429 people in line, all holding winners. That's the situation unfolding in our silver market right now, except the people in line aren't random players. They're the most sophisticated trading operations on Wall Street, all demanding physical delivery at the same time. And here's the twist. JP Morgan just closed $10 billion in short positions at the exact bottom of the January 31st crash. Finance magnates reported on February 2nd that JP Morgan stopped betting against silver at $78.29, settling 633 delivery notices at the precise crash bottom. The January 31st collapse saw silver plunge 36%, worst drop since the Hunt Brothers March 1980. Implosion triggered by Kevin Warsh's Fed chair nomination and CME margin hikes to 60%. JP Morgan doesn't surrender. When the most sophisticated trading desk on Wall Street closes a $10 billion position at the bottom of a crash, they're getting out of the way. Monday's recovery confirmed exactly what they saw coming. The squeeze is locked in, and the escape routes have been sealed. Let me show you the math. According to the Burning Platform's February 6th analysis, COMEX holds 103.5 million ounces of registered silver as of February 5th. Compare that to March open interest, 429 million ounces of delivery demands. Discovery alert. Australia's analysis puts it bluntly, that's only 24% coverage. The registered inventory isn't just low, it's hemorrhaging. The Burning Platform's data shows we're losing 785,000 ounces per day. At that drainage rate, by March 27th, first notice day, registered inventory falls to just 85 million ounces. Even if only 25% of contract holders demand delivery, conservative estimate, COMEX needs 107 million ounces it won't have. That's where JD Vance's February 4th announcement changes everything. Bloomberg and Mining.com reported Vance pitched price floors for key minerals at the Critical Minerals Ministerial meeting with 55 countries. Reuters confirmed the mechanism. Reference prices will operate as a floor maintained through adjustable tariffs across a 30-country trading bloc, including the EU, Japan, and Mexico. Think about what a price floor means for shorts. You borrow metal, sell it, plan to buy back cheaper later. Your profit depends on prices falling. But when government guarantees prices won't fall below a certain level, your strategy becomes mathematically unwinnable. Shorts can only profit in the narrow band between current price and floor, while upside losses remain unlimited. Vance's announcement landed 21 days before March delivery demands hit. The shorts who've controlled this market for decades suddenly face a position where they can't win, but can lose everything. Now here's proof this is no longer speculation. The Burning Platform's February 6th report revealed February 2026 delivery rates hit 98%, 18.72 million ounces delivered from 19.11 million open interest. In normal markets, maybe 5 to 10% of contracts result in actual delivery. 98% means traders stopped playing the paper game entirely. They're demanding physical metal immediately because they know it might not be available later. TechFlow's February 7th analysis titled Silver Delivery Crisis, Paper Prosperity versus Physical Shortage confirmed what traders suspected. March contracts represent 425 to 455 million ounces of open interest, meaning barely enough inventory to cover a quarter of claims. The timeline matters. January 31st. Silver crashes 36%. JP Morgan closes $10 billion in shorts at 78.29 bottom. February 4th, Vance announces tariff price floors. February 5th, Fortune and CBS report silver at 77.25 with registered inventory at 103.5 million ounces. February 6th, the Burning Platform publishes 429 million ounces. March demand analysis. March 27th, first notice day when this math comes due. The Burning Platform reveals another critical detail. January 2026 deliveries totaled 49.4 million ounces, 7.27 times higher than all of 2024. This isn't gradual. This is exponential acceleration. In just 7 days during January, 33.45 million ounces withdrew from registered inventory, 26% of supply vanishing in 1 week. Monday's recovery wasn't random. When silver bounced back from that January 31st crash, it confirmed what JP Morgan knew. The selling pressure is gone. The banks that manipulated this market have flipped sides. They're no longer fighting the squeeze. They're positioning for it. This isn't conspiracy theory. This is mathematics confirmed by multiple independent sources tracking the same data. 103 million ounces can't satisfy 429 million ounces of demand. Inventory drains at 785,000 ounces daily. Delivery date is fixed at March 27th. Price floors enforced by tariff policy covering 30 countries. JP Morgan just told us exactly what they think is coming by closing their largest short position at the exact moment they could have profited if prices kept falling. They recognize the game has changed. The paper market, allowing 356 ounces of claims per physical ounce, can't survive when 98% of traders demand delivery. The question isn't whether a squeeze is coming. The question is whether you understand what 103 million ounces trying to cover 429 million ounces means when there's nowhere to hide, and government just guaranteed shorts can't profit on downside, while upside losses remain unlimited. Are you holding the metal, or are you holding the bag? Now, let me show you why this isn't just a COMEX inventory problem. This is a global supply chain crisis that governments are treating as a national security emergency. And the proof is written in policy decisions that most investors completely missed while they were watching price charts. On January 1st, 2026, China implemented export restrictions that fundamentally altered the global silver supply chain. FX Street is December 28th. Analysis detailed the mechanism. China now requires exporters to have minimum capacity of 80 tons and special government licenses. That might sound like bureaucratic paperwork, but here's what it actually means. Hundreds of small and mid-size exporters who collectively controlled 60 to 70% of global refined silver supply got locked out of the market overnight. Think about that for a second. The world's largest silver refining nation just cut off the majority of its export channels right as demand is spiking. But here's what makes this move so significant. It wasn't random timing. China's government doesn't make spontaneous policy decisions. They saw the same inventory data we're looking at, and they decided their domestic industries need guaranteed silver access more than they need export revenue. And the United States government saw it too. On November 7th, 2025, the U.S. Geological Survey added silver to the critical minerals list for the first time in history. Let me put that timing in context for you. The last time our government considered silver strategically critical enough to stockpile, we were building atomic bombs. The Manhattan Project borrowed 430 million ounces of silver from the Treasury because they needed the metal as unique conductivity properties for uranium enrichment. We returned most of that silver after the war ended. But what we're seeing now suggests we're not planning to return what we were about to stockpile because the industrial applications have multiplied exponentially since 1945. Every solar panel, every electric vehicle, every AI server, every missile guidance system, every 5G antenna, they all require silver in ways that copper or aluminum simply cannot substitute. And that brings us to Project Vault. On February 2nd, the White House announced a $12 billion strategic stockpile initiative. The Export-Import Bank is committing $10 billion. And here's where it gets really interesting. The corporate participants aren't just mining companies or traditional commodity traders. According to the official announcement, Google, Boeing, General Motors, and GE Vernova are investing alongside defense contractors. Read that list again. Google, the AI infrastructure giant, Boeing, the defense manufacturer, GM, the electric vehicle producer, GE Vernova, the energy infrastructure company. These aren't speculators making bets on price movements. These are industrial consumers panic buying the raw materials they know they'll need for the next decade of production. When tech companies that build AI servers start stockpiling physical metals alongside defense contractors that build weapon systems, they're telling you something the spot price doesn't reflect yet. The market hasn't priced in what the military stopped reporting 30 years ago. In 1996, the Department of Defense stopped publishing silver consumption data. That's 3 decades of classified consumption that nobody's counting in the supply-demand calculations you see in analyst reports. And we can estimate some of it from publicly available information about weapons production. Take Tomahawk cruise missiles. The U.S. military has manufactured more than 2,300 of these since 1996. Each one contains between 15 and 500 ounces of silver, depending on the guidance package. Silver is essential for the radar systems, targeting computers, and communications equipment. And here's the critical detail everyone forgets. These missiles get destroyed on impact. That silver doesn't get recovered. It doesn't get recycled. It's gone forever, vaporized in explosions over Iraq, Afghanistan, Syria, Libya, Yemen. The Silver Institute reports an 820 million ounce cumulative deficit from 2021 through 2025. That's the gap between total mining production plus recycling versus total industrial consumption plus investment demand. But that deficit calculation doesn't include military consumption because the military stopped reporting it. So when analysts tell you the market has been in deficit for 5 years, they're actually understating the problem because they're missing the classified consumption data. Now let's talk about what's happening in real time at the COMEX because the delivery data tells us traders are front-running the March crisis. We already covered the 49.4 million ounces delivered in January, 7 times higher than all of 2024. But look at the withdrawal pattern more closely. The Burning Platforms analysis showed 33.45 million ounces withdrawn in just 7 days. That's not normal trading activity. That's institutional players pulling metal out of the system as fast as the paperwork allows. And here's something fascinating that TechFlow's February 7th report revealed. Traders are paying premiums to pull March contracts forward into February delivery. In a normal futures market, later contracts trade at a premium to earlier ones. That's called contango, and it reflects storage costs and time value of money. But right now, March contracts are trading with urgency pricing that says, I'll pay extra to get my metal now instead of waiting until March. That's called backwardation. And TechFlow reported the exchange for physical spread hit $1.10 per ounce. That might not sound like much, but in the institutional silver market where players trade million-ounce positions, that's $11,000 per contract they're willing to pay just to move delivery forward by 1 month. They're front-running the March crisis because they can see the same math we're looking at. Let me connect this to something you can actually see in your daily life. You know how your phone uses silver? The touch screen, the circuit boards, the 5G antenna, all contain silver because nothing else has the same combination of conductivity, durability, and reliability at the atomic level. Now think about how many phones get manufactured every year. Apple alone produces over 200 million iPhones annually. Samsung produces similar numbers. Add in every other smartphone manufacturer, and you're looking at over 1 billion phones per year, each containing a fraction of an ounce of silver. Now multiply that same industrial demand across electric vehicles. Each EV contains between 1 and 2 ounces of silver in the electrical systems. Solar panels. Each panel contains about 20 grams. AI servers. The data centers that run ChatGPT and Claude and every other AI system consume massive amounts of silver in their power distribution and cooling systems. And military equipment. Everything from fighter jets to aircraft carriers to missile defense systems. The industrial demand isn't decreasing, it's accelerating. And that demand is hitting a supply chain that China just restricted that's been running cumulative deficits for 5 years, that has COMEX registered inventory draining at 785,000 ounces per day, and that faces 429 million ounces of March delivery demands. Now, here's where the national security angle becomes crystal clear. When the US government designates something as a critical mineral, they're not making an economic statement. They're making a strategic assessment. Critical minerals are materials where supply disruption would threaten national security. That designation triggers a whole cascade of policy responses. Domestic production incentives, strategic reserve programs, export restrictions on processed materials, and yes, tariff-enforced price floors to prevent market manipulation from threatening supply chains. Vance's February 4th announcement wasn't just about supporting the mining industry. It was about ensuring the defense industrial base has guaranteed access to materials that can't be substituted. You can't build F-35 fighters without silver. You can't operate satellite networks without silver. You can't manufacture precision-guided munitions without silver. And if China controls the supply and decides to restrict exports, which they just did on January 1st, then the United States needs alternative supply sources with guaranteed pricing. That's what the 30-country trading bloc accomplishes by coordinating with allies in Europe, Japan, Mexico, and elsewhere to establish reference price floors maintained through tariffs. The U.S. essentially created a parallel silver market that's protected from the manipulation that's kept prices suppressed for decades. And the short sellers who've profited from that manipulation just lost their playground. Look at the current price action with this context in mind. CBS News reported silver at $76.06 on February 5th. Fortune had it at $77.25 that same morning at 8:30 Eastern Time. Compare that to the $81.89 level on February 2nd, right after the Monday recovery from the January 31st crash. The price is consolidating in the high 70s after bouncing from the 78.29 bottom, where JP Morgan closed their shorts. What does that consolidation tell us? The market is digesting the new reality. The panic sellers are gone. They got washed out on January 31st. The short sellers are trapped. Vance's price floor announcement eliminated their exit strategy. The institutional buyers are accumulating, hence the 98% delivery rates and the willingness to pay backwardation premiums. And the price is holding above the level where the smartest money on Wall Street decided to stop fighting the squeeze. Your audience knows these price levels intimately. They've been watching the charts, tracking the spreads, analyzing the delivery data. So let me be direct. If you think $76 to $78 is expensive for silver given this setup, you're not paying attention to the fundamentals. The supply-demand equation is broken. The inventory can't cover the delivery demands. The government is treating this as a national security crisis, and the institutions are pulling metal out of the system at unprecedented rates. Project Vault's $12 billion stockpile isn't a price speculation play. Google doesn't invest in commodity stockpiles because they think prices might go up. They invest because they have done the math on their future production requirements and realize the supply chain can't deliver the volumes they need at any price the paper market currently reflects. When a tech company that is building the AI infrastructure for the next decade starts stockpiling physical silver alongside Boeing building military aircraft and GM building electric vehicles, they're telling you the market price is wrong by orders of magnitude. The 80-ton export restriction from China isn't just bureaucratic oversight, it's supply chain warfare. China recognized that silver is as strategically important as rare earth elements or semiconductor manufacturing equipment, and they're securing their domestic supply before the global shortage becomes obvious to everyone. The fact that they implemented this on January 1st, just days before Vance's price floor announcement and weeks before the March delivery crisis, suggests coordination at the highest levels of strategic planning. And the DoD stopping silver consumption reporting in 1996, that wasn't transparency reform, that was classification. They didn't want potential adversaries knowing how much silver American weapon systems require. But that classified consumption means the 820 million ounce deficit everyone quotes is actually understating reality by however many hundreds of millions of ounces the military has consumed in 30 years of operations, including 2 Gulf Wars Afghanistan, the drone campaign across multiple countries, and the hypersonic weapons development program. This is why the March 27th deadline matters so much. It's not just another futures expiry. It's the first major delivery date after China's export restrictions kicked in, after the U.S. designated silver as critical, after Project Vault announced $12 billion in stockpiling, after Vance established price floors, and after traders demonstrated with 98% delivery rates that they're done playing the paper game. All of these pieces are converging on one date when 429 million ounces of demand meets 103 million ounces of supply that's falling by 785,000 ounces every single day. The question isn't whether the squeeze happens. The question is whether you positioned yourself before the math became undeniable to everyone watching. Now let's do the math that Wall Street doesn't want you to calculate. March 27th is first notice day. That's when contract holders can officially demand physical delivery. According to the Burning Platform's February 6th analysis, open interest for March contracts stands at 429 million ounces. COMEX registered inventory on February 5th was 103.5 million ounces, draining at 785,000 ounces per day. From February 5th to March 27th is 50 days. That's 39 million ounces of additional drainage, leaving 64 million ounces on first notice day. Even conservatively assuming drainage slows, we're looking at 85 to 90 million ounces available to meet 429 million ounces of demand. Let's be extremely generous and assume only 25% of contract holders demand delivery. That's still 107 million ounces needed against 85 million available. The math doesn't work, and every trader watching these numbers knows it. What happens when a commodity exchange can't deliver? You've got 3 options, none good for the paper market. Cash settlement, admitting paper contracts aren't backed by metal, destroying futures market credibility. Default declaration, triggering cascades through the financial system like 2008. Or intervention, like March 1980 when the Hunt brothers pushed silver from $6 to $50 in months, before the government changed the rules and forced liquidation. But here's the critical difference. The Hunt brothers were speculators manipulating the market. Today we have industrial demand colliding with inadequate supply while governments stockpile for national security. You can stop speculators. You can't stop the Department of Defense needing silver for weapon systems or Google for AI infrastructure. This is where Vance's price floor becomes a lethal trap. Shorts can only profit between current price and floor, maybe $17 of downside if the floor is 60. But upside losses remain unlimited. With government supporting the floor through tariffs, you've got maybe 20% profit potential down versus unlimited loss potential up. No sophisticated trader takes that bet. Shorts are trapped and need to close positions, which means buying. And when everyone buys simultaneously, prices explode. Now factor in the paper to physical ratio. Multiple analyst reports confirm 356 ounces of paper claims for every 1 ounce of physical metal. That worked when only 5 to 10% demanded delivery. But February hit 98% delivery rates. If March follows the same pattern, you've got 356 claims competing for 1 ounce, while the exchange must deliver 98% of them. The math becomes impossible. We're already seeing this in backwardation. TechFlow reported traders paying $1.10 per ounce premium to pull delivery forward. As March approaches, those premiums explode. Physical trades at $10 over paper, then $20, then $50. The paper market becomes irrelevant because nobody trusts it anymore. That's when real price discovery happens, when 356 claims try to find actual metal at any price. Now let's talk actual price levels, because your audience wants numbers. The current gold to silver ratio sits around 64-1. Historically, it's been much tighter, 50-1 average, compressing to 30, 20, or 15 during bull markets. In January 1980, at the Hunt Brothers peak, it hit 15-1. Some analysts argue it should be 10-1 based on actual availability. Yardeni Research projects gold reaching $10,000 as central banks expand balance sheets and devalue currencies. If gold hits $10,000 with even a 30-1 ratio, silver trades at $333. At 20-1, you're at $500. At 10-1, you hit $1,000. But it's not just ratio math. Ted Butler, tracking COMEX manipulation for decades, points out the 1980 peak of $50 equals $150 to $1,400 today, depending on inflation measures. Official CPI gives 150. ShadowStats methodology yields 4 to 600. Monetary base expansion justifies 1,000 to 1,400. Current silver at $77 isn't expensive. It's cheap. The 1980 peak inflation adjusted should put us between 150 and 600 minimum just to match previous highs. But we're exceeding those conditions. In 1980, we had speculator-driven manipulation. Today, we have structural deficits, industrial demand growth, government stockpiling, export restrictions, and critical mineral designation. The path to 1,000 has clear milestones. First stop, $150, matching inflation-adjusted 1980 peak. This happens fast once March delivery crisis triggers short covering. Then 2 to 300 as paper markets break down and physical premiums explode. Next is 500, where you'd be with gold at 10,000 and 20-1 ratio, or with the 356 to 1 paper ratio completely imploding. Finally, 1,000, which requires gold at 10,000 with 10-1 ratio compression. And here's why that's realistic. The 22,000 tons sitting in London vaults, roughly 707 million ounces, belongs to central banks, sovereign wealth funds, and strategic investors who aren't selling at current prices. They accumulated specifically because they understood the supply deficit was coming. They're not selling at 77, not at 150, maybe not at 500, because silver is critical national security material that governments need for weapons. Tech companies need for AI automakers, need for EVs, and the Silver Institute project's deficits persisting through at least 2027. 700 million ounces barely covers 2 years of annual deficit. When COMEX defaults and governments and corporations realize they need actual metal they can't get elsewhere, bid-ask spreads blow out. Someone offers $100, no seller. 200, still nothing. 300, 500. The scarcity value of a critical material that can't be substituted and takes 7 to 10 years to bring new mines online gets priced in. Mining can't save us. New mines take 7 to 10 years. Expansions take 2 to 3 years minimum. The deficit has run for 5 years already. Even if every company started expansion tomorrow, supply doesn't arrive until 2028 or 2029, and by then deficits will have widened as industrial demand grows faster than new supply develops. This is why Project Vault exists. Google, Boeing, and GM stockpiling alongside defense contractors because they've done the math. They know supply isn't coming, deficits persist, and within 2 to 3 years they either have metal or don't have production. Google won't let hundreds of billions in AI infrastructure get delayed over securing a few $100 million in silver. They buy at 77 or later at 500, or don't build at all. Same logic applies to Pentagon weapon systems. They'll pay whatever price necessary, which is exactly why government designated silver critical and established price floors. The timeline is compressed. March 27th. First notice day is the catalyst, but the process is already underway. January deliveries at 7 times 20, 24 levels. February delivery rates at 98%. Inventory draining daily. JP Morgan closing shorts at the exact bottom. Vance establishing price floors 21 days before first notice day. China restricting exports. Every piece is moving into position. Remember how we started, with a lottery ticket and only enough money to pay 3 tickets when 429 people hold winners. Now you understand what happens next. The Lottery Commission either admits they don't have the money, destroying all confidence forever, or pays prices far above what tickets originally cost. Either way, people in that line discover their tickets are worth multiples of paper prices. The smartest money already figured this out. That's why JP Morgan closed shorts at 78.29. That's why delivery rates hit 98%. That's why traders pay premiums for immediate delivery. That's why Google and Boeing are stockpiling. They're not holding paper, they're holding metal. Tomorrow morning, when that opening bell rings, we witness the collision between 429 million ounces of demand and 103 million ounces of supply. The math doesn't work. The shorts can't profit on the downside, but can lose everything on the upside. The paper market is breaking, and the path to $1,000 is paved with the mathematical certainty that 356 claims for every ounce of physical metal cannot possibly deliver when 98% demand actual metal. So I'll ask you one final time. Are you holding the metal, or are you holding the bag?